You work hard for your money. You deserve to have your money work hard for you. A step-up SIP is a smart way to do just that. Let's break it down. The SIP is a systematic investment plan. It means you invest a set amount every single month. Think of it like a monthly bill you pay to your future self. A step-up SIP is a special kind of SIP. You start with an amount that feels easy for you. Then you choose to increase that amount over time, usually once a year, often when you get a pay raise. It grows as your life and income grow. This matters for your family's financial security. Life is not static. Your income today won't be your income 5 years from now. A step-up SIP acknowledges that. It aligns your saving habits with your earning power. When you earn more, you automatically save more. Not a huge, scary leap. Small, manageable steps. Small, consistent steps build lasting wealth. A gentle way to save more without the pinch. It is disciplined. It is powerful. And it is something every family can do. The benefits are clear. First, start small. You don't need a lot to begin. Second, the plan grows with you. Families choose a step-up SIP because it is realistic. Your family's financial life is full of changes. One year, you might get a wonderful salary increase. Another year, your expenses might go down as a child finishes a costly class. A rigid savings plan does not account for this. A step-up SIP is flexible. It allows you to match your savings to your real-world circumstances. When your income grows, you have a plan in place to put some of that new money to work for your future. You are not leaving that extra cash sitting in a bank account where it can be easily spent on things you do not truly need. This method makes saving feel smooth and natural. Let's be honest. It is difficult to suddenly start saving a very large amount of money each month. It can feel like a shock to your budget and your lifestyle, but increasing your savings by a small amount once a year, that is easy. It is much easier for people to save a little more over time than it is to make a huge one-time jump. This gradual approach helps you build wealth without feeling deprived. It is a smart, psychological trick you play on yourself. Before you know it, you are investing a significant amount each month, and you barely notice the change along the way. Think of it as training for a financial marathon. You would not just wake up one day and run 26 miles. You would start with 1 mile, then 2, and slowly build your endurance. A step-up SIP is the same principle applied to your money. You start with a comfortable amount, your 1 mile run. Then next year, you increase it slightly. You are building your financial muscle over time. This process creates a powerful sense of momentum and accomplishment. Before you take a single step, you must know where you're going. You must ask yourself and your family one simple question. Why are we saving this money? You need to write down your goals. Be specific. Do not just say, for the future. A goal needs a name and a deadline. For example, saving for a down payment on a new home in 5 years. Or creating an education fund for your child who will start college in 15 years. Or building a retirement nest egg that you will need in 25 years. Each goal has a time frame and a specific amount of money it requires. This clarity is your map. Once you have your goals, you must know your starting point. This means looking honestly at your family's budget. You need to know your numbers. List all the money that comes into your household each month. Then, list all the money that goes out. Track your expenses for a month if you are not sure. This is not about judging yourself. It is about empowering yourself with knowledge. Once you see where your money is going, you can find the amount you can comfortably save right now. This will be your starting SIP amount. It is okay if this number is small. The most important thing is to start. Many families make the mistake of trying to save too much, too soon. They pick a large number that looks good on paper, but is impossible to maintain. Then, after a few months, they get discouraged and stop altogether. That is not the path to wealth. I want you to pick a number that feels easy. A number you know you can stick with for at least 1 full year without any stress. This could be $2,000 a month, or $5,000, or whatever works for you. The power of a step-up SIP is not in the starting amount. The power is in the commitment to increase it over time. Start where you are, with what you have. Finally, you must consider your emergency fund. This is non-negotiable. Before you begin investing heavily for long-term goals, you must have a safety net. Now that you have your starting amount, it's time to move from a simple investment to a dynamic strategy. We're going to design your personal step-up blueprint. This isn't just a plan, it's an automated system for your financial growth, a commitment you make once that pays dividends for years. Think of it as putting your wealth creation on autopilot, ensuring your financial goals get the attention they deserve without requiring constant effort from you. The first decision in your blueprint is timing. How often will you increase your investment? The most common and simplest option is an annual step-up. This means you increase your SIP amount just once every year, on a specific date. This approach aligns perfectly with the natural rhythm of most people's financial lives. The smartest way to implement this is to time it with your annual salary review at work. When you get a raise, a portion of that new income automatically goes toward your savings goal before you even get used to seeing it in your bank account. This is your secret weapon against lifestyle inflation, the tendency to spend more as you earn more. By pre-committing to saving a part of your raise, you choose to pay your future self first. Next, you must choose how much to increase your investment by. This is where you define the step in your step-up plan. There are two simple and effective choices here. The first is a fixed amount increase. For example, you might decide to increase your SEP by a set amount, like 500 or 1000 rupees, every single year. This method is simple, predictable, and incredibly easy to set up. It's a great choice if you prefer straightforward, consistent numbers and want to know exactly how much your investment will increase each year. The second option, which is often more powerful over the long run, is a percentage increase. For instance, you could choose to increase your SIP amount by 10% each year. If you start with 2,000 a month, a 10% step-up would mean you invest 2,200 a month in year 2 and 2,420 a month in year 3. The increase itself grows over time. A percentage increase helps your savings growth keep pace with your income growth, especially if your salary also tends to increase by a percentage each year. It scales with you. So, which method is right for your family? A fixed amount offers simplicity, while a percentage offers scalability. There is no single correct answer. The best plan is the one that feels manageable and that you can stick with. Consider your career path, your comfort with numbers, and choose the path that makes the most sense for your journey. Choosing the right investment fund is like walking into a workshop and choosing the right tool for a job. You have a specific project in mind, and you need the perfect instrument to get it done right. You wouldn't use a hammer to saw a piece of wood, nor would you use a delicate screwdriver to break up concrete. Each tool has a purpose. In the same way, the fund you choose must be perfectly aligned with your goal's timeframe and your family's comfort level with risk. These two factors, time and risk, are intrinsically linked. The more time you have, the more risk you can generally afford to take, because your investments have more time to recover from any potential market dips. Let's start with time and break down your goals into different time horizons. For short-term goals, things you need money for in less than 3 years, like an upcoming vacation or a deposit on a rental home, you must prioritize safety above all else. For these goals, you should look at liquid funds or short-term debt funds. Think of these as lending your money for a short period in exchange for interest. Their value doesn't fluctuate much, so your money will be there when you need it. You can't risk a market downturn wiping out your savings just before you need to access them. The returns will be modest, but the goal here is capital preservation, not high growth. You want to protect what you've saved. Now, for medium-term goals, perhaps 3 to 7 years away, your strategy can change. Here, you can afford to take a little more risk for the potential of a little more growth. This is where hybrid funds, sometimes called balanced funds, come into play. These funds are a mix of different asset classes. They invest in both stocks, also known as equities, which offer higher growth potential, and bonds, also known as debt, which provide stability. They offer a good middle ground, providing some of the growth potential of stocks, while the bond portion acts as a cushion during market downturns, smoothing out the ride. This balance can be a smart choice for goals like saving for a car, funding a small business, or building a down payment on a house that is still a few years away. It's about finding that sweet spot between protecting your capital and helping it grow a bit faster. For your long-term goals, those that are more than 7 years in the future, you have a powerful advantage. Time is on your side. This extended horizon isn't just about waiting, it's about giving your money the runway it needs to grow, and, crucially, to recover from the inevitable bumps in the market. It allows you to think in terms of decades, not days. This is when you can harness the power of equity funds. These funds invest primarily in stocks, which are essentially small shares of ownership in various companies. By investing in an equity fund, you become a part owner in a diverse portfolio of businesses, sharing in their potential for growth and success. Over the long run, equities have historically provided the highest returns compared to other asset classes. While past performance is never a guarantee of future results, this historical trend is a fundamental reason why they are so well suited for goals far in the future. However, this potential for higher returns comes with higher volatility. Their value will go up and down more frequently and dramatically than other funds. This is the nature of the stock market, reacting to economic news, industry trends, and global events. But time is your greatest ally in smoothing out that volatility. Goals like your retirement or your young child's college education are perfect for equity funds. You have many years for your investment to grow and recover from any market dips along the way, allowing you to ride out the short-term noise. Finally, and this is critically important, you must look at the costs. Every mutual fund charges a fee called an expense ratio. It's disclosed in the fund's prospectus and represents the annual cost of running the fund. This is a small percentage of your investment that is taken each year to cover the fund's operating costs, including manager salaries and administrative expenses. While it may seem small, often less than 1%, this fee can have a big impact on your returns over many years due to the power of compounding in reverse. It's a small leak that can drain a surprising amount from your portfolio over time. Always look for funds with a low expense ratio. This is one of the few factors in investing that you have direct control over. There is no reason to pay high fees when there are many excellent low-cost funds available, especially index funds that passively track a market index. Research consistently shows that high fees do not guarantee better performance. Keeping your costs low means more of your hard-earned money stays invested and working for you, compounding year after year for your family's future. Every dollar you save in fees is a dollar that can grow and contribute to achieving your most important goals. Sometimes, seeing the numbers can make it all click. Let's walk through a simple, clear example. Imagine your family has a goal: save for your child's higher education, 12 years away. You can comfortably start by investing $2,000 per month. You know your income will likely grow, so you choose a step-up plan. You decide to increase your monthly SIP by 10% every year. You choose an equity fund aiming for an average annual return of 12%. This is just an example. Actual returns will vary. First year, invest $2,000 every month. Total $24,000 for the year. Start of second year, 10% step-up kicks in. New monthly is $2,200. You barely feel this extra $200. But it makes a difference. Third year increases by another 10% to $2,420 per month. This small, consistent increase continues every single year. Without step-up, $2,000 a month for 12 years. Total invested $288,000. With 12% assumed return, that could grow to around $600,000. With step-up, total contribution $496,000. because more money worked for longer. Final amount could grow to over 950,000. That is a huge difference, all from small manageable annual increases. Once your plan is in motion, your job is to stay the course. Balance your need for safety with your desire for growth. Think of your money in different buckets. Emergency fund bucket. Safety. That money sits in a secure savings account, ready for a crisis. Investment buckets. Multiple SIPs. Many families use at least 2 SIPs running simultaneously. Each SIP has a different purpose. For long-term goals like retirement, have a step-up SIP in a growth-oriented equity fund. This is the growth bucket. It will see ups and downs, but you have years to grow. Accept volatility for higher long-term returns. At the same time, another smaller SIP for a medium-term goal, like replacing the family car in 4 years. Put that SIP in a more stable hybrid fund, or put it in a debt fund. Chase growth for the future while keeping nearer-term needs relatively safe. One of the hardest parts of investing is controlling your emotions. The market will go down, not a matter of if, but when. Your first instinct might be to panic and stop your SIP. That's the worst thing to do. When the market falls, fund unit prices drop. Your fixed SIP amount buys more units now. You're essentially buying on sale. Stopping your SIP during a fall is like running out of a store with 30% off signs. Trust the plan and keep investing. Review your plan once a year. This is not a time to panic, but to calmly check in. Look at your goals. Have they changed? Look at your income. Has it changed significantly? Look at your fund's performance. Is it underperforming peers over several years? If so, consider a change. Don't make changes based on short-term news or fear. On the path to financial security, there are common traps that many people fall into. Your job is to recognize them and avoid them. The first mistake is starting a plan but never actually using the step-up feature. The magic is in the increase. If you start small and stay small, you will not reach your goals. The second trap is chasing past performance. People often pick the fund that was number 1 last year. That is like driving by looking only in the rearview mirror. Instead, you must look for funds with consistent, steady performance over 3 years, 5 years, 10 years. Consistency is more important than a single year of stellar returns. Another common mistake is putting all your money into high-risk funds when you have a short-term goal. If you need money for a house down payment in 2 years, that money does not belong in a high-risk equity fund. A market downturn could wipe out a significant portion of your savings right when you need it. You must match your risk to your time frame. And please do not ignore your emergency fund. I have said it before, and I will say it again. Building a 6-month emergency fund is the first step you must take before you start a serious investment plan. It is your ultimate protection. Now, let's talk about the good habits that build wealth. The most important habit is to automate everything. Set up your SIP so the money is automatically debited from your bank account on the same day each month. Set up your step-up so it increases automatically once a year. Automation builds discipline and removes temptation. Another great habit is to link your step-ups to a positive event, like your annual salary increase. When you get your raise, you have already decided that a portion of it will go to your future self. This makes saving feel like a reward, not a sacrifice. Finally, make saving a family affair. Talk openly and honestly with your spouse. Talk openly and honestly with your partner. When you work as a team, you are much more likely to succeed. Keep your goals written down where you can see them. This reminds you why you are making these smart choices every month. You have the knowledge. Now it is time for action. Do not wait for the perfect time to start. The perfect time is right now. Here is a simple checklist to get your family on the path to financial freedom with a step-up SIP. Go through these steps one by one. Do not feel overwhelmed. Take the first step today. Take the next one tomorrow. You can do this. This is your plan to take control of your money. Build the future your family deserves. Become the master of your financial destiny. First, define your goals. Sit down with your family and write what you're saving for. Note when you'll need the money. Be specific. Second, know your budget. Figure how much you can comfortably invest each month. Start with an amount that feels easy. Third, Choose your step-up rule. Fourth, select your funds. Equity, hybrid, debt. Match fund type to your goals timeframe and your comfort with risk. Next, keep your costs low. When comparing funds, always check the expense ratio. Choose funds with lower fees. Every rupee you save in fees is a rupee that works for you. Sixth, automate the entire process. Set up automatic monthly investments. Set up automatic annual step-up. This is the key to consistency. Seventh, build your emergency fund first. Make sure you have 3 to 6 months of living expenses in a safe bank account. Finally, commit to an annual review. Put a date in your calendar 1 year from today. On that day, review your plan, check your goals, and make sure you're on track. Do not panic during market dips. Trust the process. A step-up SIP is not a get-rich-quick scheme. It is a get-rich-for-sure plan if you have the discipline to stick with it.